Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of hosting my favorite guest, Paul Moore. Welcome to the show, Paul. I appreciate your time today.
Hey, it's great to be here, Sakar.
Awesome. Thank you, Paul. And a little bit about Paul. Paul started his career with Ford Motor Company, and he founded after that, he founded his staffing company. And he sold the staffing company after a few years and went into real estate. Today, he is a proud owner of Wellings Capital, a big capital management firm who has established several funds. Their focus is self-storages and other alternative classes. He is the author of popular book, The Perfect Investment, Creating Enduring Wealth from the Historic Shift to Multifamily Housing and Storing Up Profits, capitalize on America's obsession with stuff. So welcome to the show, Paul. I appreciate your time. You want to kick off by giving us a few more tidbits about your background and how you got started with and came into commercial side of the house with your Wellings Capital?
Yeah, so when I sold my company at 33 years old, I first of all found out that so-called semi-retirement was really, really boring. I was a high-energy entrepreneur in my mid-30s, and just a big mistake to think about, retiring at that age. And so I decided I would be a full-time investor. Mm-hmm. Well, I wasn't a full-time investor. I lied to myself. I actually became a full-time speculator because I did not know the difference between investing and speculating. Investing is when your principal is generally safe and you've got a chance to make a return. And speculating is when your principal is not at all safe and you've got a chance to make a return. And I didn't know the difference. I made a lot of mistakes. I lost a lot of money. I made some money along the way. I learned a lot of hard lessons. And one thing I did learn is that we learn everything in life almost from two things. Number one, from mentors, and number two, from our mistakes. And if we can learn from mentors, people like you on this podcast and people who have made mistakes in the past, we can hopefully not repeat those on our journey.
I would totally agree with you, Paul. And as they say, the success is falling fast and falling forward. It doesn't matter how many times you fail. It matters, the number of times you want to get back up and keep pushing. I couldn't agree more. I'm a big believer of psychology and, how you tune your mind, your attitude, and you keep learning. And the part about mentors is, why reinvent the wheel? If you can have veterans, guide you who've been there, that's the success mantra right there. So I couldn't, agree with you more. So Paul, I know at Wellings Capital, you invest in self-storages, right? So for people who may not have heard self-storage, or perhaps they may have seen a self-storage, what it's like, could you maybe give us some preliminary background as to what a self-storage is, how it works from a business side as well?
Yeah, so self-storage is both a retail business and real estate. And there are 53,000 or so self-storage facilities in the U.S. That's about the same as all the McDonald's, Subway, and Starbucks combined in the U.S. And a large percentage of those are run by mom and pop owners who don't have the resources or the desire or the knowledge to upgrade and to maximize their income and value. So it does provide a great opportunity for investors. The premise behind self-storage, the first self-storage facility was in the oil fields of Texas in the 1960s, and then people commercialized it through the 70s and mainly in the 80s and rolled it out across the US. The thing we love about self-storage is that it's not recession-proof by any means, but it does well in good times because people are filling up their Amazon or their Walmart carts, and sometimes they have parents who are passing away and they need more stuff. They need places to store their more stuff.
Sure.
And so it seems to expand well in good times, but in bad times, we experience the 4 Ds, which are dislocation, downsizing, death, and divorce. And during those times, people are often, dislocation is sort of a catch-all, but it could include, maybe uprooting from their job, maybe moving, maybe downsizing, from a larger house to a smaller house. Those types of things are times when people rent self-storage. And another thing about self-storage that's really interesting is if I was charging $1,000 a month for a rental home or apartment, and I raised your rent 6%, you might move rather than sign that piece of paper that locks you in for $60 a month, which is $720 a year. But if I raise your rent on a $100 self-storage facility on a month-to-month lease by 6%, you're probably not going to spend a Saturday, get your friends together, rent a U-Haul to take your stuff down the street.
Not a fun experience.
Yeah, just to save $6 a month, especially when you think I'm only going to be here a few more months anyway, which is a common misconception among self-storage renters.
Good. And help us understand, Paul, there that, like, for example, when I rented the self-storage last time, right? Those add-ons, whether you are purchasing, I don't have a lock, or, hey, can I maybe purchase a tape? So from a business standpoint, I know that, the add-on services, as we call it, they tend to be very lucrative. And I found that self-storage are in a perfect spot that, let's say if the consumer has not come prepared there, whether it's your small ropes or the locks or the scissors and, all the paraphernalia that comes with this, right? Those small upcharges that come with some of the, or the premium, as I call it, like, you can buy a lock by going to, your local store for like, let's say $10, but you could end up buying this here for $12, $15. So could you give us some insights into how are we optimizing the self-storage business from an operational perspective to kind of, gain more income into the business?
When I, a couple of years ago, when I first heard about the concept of value adds in self-storage, I laughed because I thought, well, I know about value adds in a multifamily. I wrote a book on multifamily, and you don't have carpet and cabinets and paint and lighting and so many things to do value add and to increase the rents. Self-storage, when someone leaves, all you have to do is sweep it out. It's 4 pieces of sheet metal, a slab of concrete, and a door. How can you get value adds in that? Well, you're right. There's all kinds of retail items you can add, like locks, boxes, tape, scissors. You can also charge an admin fee. You can charge late fees. You can actually add U-Haul. Now let's do the math on this. So adding U-Haul typically adds $2,000 to $5,000 a month to the revenue, but there's no significant cost to that. I mean, you have to have space for the U-Hauls to park. But you get $2,000 to $5,000 in commission. Let's say it's $4,000. Now let's go back a step to why I love commercial real estate. Did you know that the Forbes 400, the wealthiest people in the world, almost all invest in commercial real estate? And one of the reasons is this value formula. It's math. Basically, the value formula is the value of a property is the net operating income divided by the rate of return, or the cap rate.
The cap rate, correct.
And so if we can increase the net operating income, and sometimes we can shrink the cap rate, we can significantly increase value and even increase more by using safe leverage. So let's go back to our U-Haul. So we had $4,000 a month, which is $48,000 a year to our revenue.
Sure.
That goes straight to income.
Right.
And so if we add $48,000 a year to our net operating income, let's say we're at a cap rate of 6%.
Sure.
So $48,000 per year divided by 0.06.
Right. Mm-hmm.
Look at that. $800,000 we just added to the value of facility. Now let's say we bought that facility for $3 million, and that was $2 million in debt plus $1 million in equity. We just added 80% to our equity from one stroke of a pen by bringing U-Haul in, and of course getting U-Haul up and running and implemented for a number of months.
Sure.
It added 80% to our equity. That's a pretty powerful value add.
Absolutely. Now, going back to these facilities, Paul, right? Like, for example, as you indicated, right, people are buying more and more stuff, storing, so the demand is definitely going higher. What does it go into finding the right locations? Is it, something closer to like developing neighborhoods, or maybe perhaps closer to the highways and things like that? What factors do you consider into acquiring a self-storage?
Yeah.
What kind of plays into that?
Yeah, so we recently invested in a self-storage facility. It was a ground-up development about 25 miles northwest of Minneapolis. And the average neighborhood and the average demographics included a neighborhood income in a 3-mile radius of about $98,000 average. It was on a main road in the city, and it only had 2 square feet of self-storage per person in that 3-mile radius. And there was virtually no climate controlled self-storage, and you need that in Minnesota. So the factors we want to look at, number one, are, the number of square feet of storage per person. So in an urban area, you might look at a 1-mile radius. In a normal suburban area, a 2 to 3 to 4 mile radius, call it 3. And then in a rural location, which I wouldn't recommend anyway, you might look at a 5 to 10 mile radius.
I see.
So you're looking for 10 years ago, a study showed that there's about an average of 7 square feet of storage per person in the US, much more in places like Florida, Texas, and California that don't have basements and use their attics much. And somewhat less in Midwestern areas like Ohio, Indiana, Illinois, et cetera, that have a lot of basement storage and they have a milder climate. That was 10 years ago. We believe that 7 square feet now should be closer to 9 square feet per person. The second factor is the demographics. We like to look at the income in the area. It doesn't have to be real high, but we want it to be above average income. Third, we want it to be on a main road. Fourth, we want it to have a lot of visibility on that main road. And fifth, if possible, we like it to be in a location with a lot of barriers to entry so we don't get a lot of new competition coming in, because that's the biggest risk in self-storage, is a new competitor popping up down the street.
Sure. And I'm glad you bring that up, Paul, that right now we find ourselves that, Cube Storage or Cube Smart or self-storage, which are, a lot of these are bigger Wall Street players who are coming in and installing, let's say multi-storage, climate controlled, automated locks, surveillance systems, elevators in some of them and things like that. So what's the value play? Are you maybe focused more on the mom and pop operators and, acquiring them, perhaps multiple of them via using your fund and optimizing them? Is that the thesis of your investment, more or less?
Yeah. About 75% of the self-storage facilities in the U.S. are run by small operators, and about 50 of the 75 are mom and pop operators. A lot of those are in the path of progress. A lot of them, like I'm thinking of one right now in Roswell, Georgia. We both know the operator of that facility in Roswell. You and I both have invested with them, I believe. And they were a small little sleepy town way outside of Atlanta when that facility was built in 1976. But now that's a booming suburb of Atlanta, and it's really hard to find any land to build on near there. And so it's a great location to have a self-storage facility. Now, by buying that from a mom and pop, the operator was able to add a beautiful showroom, locks, boxes, tape, scissors, U-Haul, all that, and significantly expand the income and also the operations. And so that is the priority, the goal, the end game. The beginning game is to acquire from a mom and pop, pay them a fair price. The middle game is to upgrade the income and, of course, the value. And then the end game is to put a bunch of those together in a portfolio and sell it to a REIT for a compressed cap rate, which means a higher price.
Absolutely, absolutely. Thank you for clarifying that, Paul. And now when you package all this, right? So how is all the financing handled in this? Like, let's say when you're acquiring this, I know, like, for example, in the multifamily side of things, we know that you're going to Fannie Mae and Freddie Mac or even bridge loans and things like that. Could you share some insight into what goes on behind the scenes, like how you're evaluating? Is it strictly NOI based, or are you like, is the lender looking at some value add services and things like that? And more importantly, who are the lenders? Like what sort of details go into financing of these?
Yeah, so it's very similar to multifamily. It's using the same formulas, same reserves, similar, similar appraisal metrics, similar interest rates, similar, interest only loan, 5, 7, 10, or 12 years, interest only the first 3, for example. Fannie and Freddie love self-storage, and they're doing those. They love mobile home parks, probably at least as much, maybe more. And there's a bank, I'm trying to think, it's in Wilmington, North Carolina. It's Live Oak Bank, and they are really aggressive in the self-storage arena as well. And so that's a bank to look for if you're looking to acquire, especially a $1 to $5 million self-storage facility.
Good. Thank you for clarifying that. Now I'm going to shift gears a little bit, Paul. Given the COVID pandemic that sort of happened, and we are still into.
I never heard about that. What is
it? Well, let me say this: the coronavirus, right? If that sounds any familiar, right? So here we are, like the main businesses and a lot of small businesses are hurt. The pandemic has pretty much gone on to the main street, hurting all the businesses, wiping out a lot of blue-collar jobs. Without a question, we are going to see the A's compressing to B classes, and of course, a lot of people are going to downsize, or even for that matter, businesses are going to shutter the doors and bring all their assets and equipment down into your storage facilities, right?
I never thought of that, but you're probably right.
Right. So talk about, someone paying a lot much rent in an industrial facility, like, let's say a neighborhood plumber for that matter, or a heating technician. He might say, hey, you know what? Why am I renting this space? Let me downsize, let me store all my stuff, and I'm probably going to operate a lot of stuff out of my, out of my trucks, or for that matter, right? So where I'm going with this, Paul, is that how do you see this playing out? Because in my mind, the wound of the pandemic is deep. I mean, we are incurring record debt right now, whether it's family debt or whether it's national debt. So the no picture that you can paint is rosy. How do you see this playing out? At a broader scale, whether it's commercial in general or whether towards your self-storage facilities in general?
Yeah, there's so much we could talk about on this.
Absolutely.
But here's the real problem with everything that you or I could say, and that is we don't know what we don't know. When have we been faced with a pandemic of this size? Well, it's been 102 years. When have we been faced with a pandemic at the same time as by far record unemployment, even if some of it's temporary, a lot of it's not, right. A record amount of debt, record amount of printing of money at the national level.
Absolutely.
Possibility that the pandemic might come back, and all the fear with that it might just keep coming back, and this might be the beginning of the rest of our lives. You know, I got my first haircut today in a mask. I didn't really enjoy that. But what if that's going to be it from now on? So I don't know what I don't know. I do believe this, though. Howard Marks, in his classic book, Mastering the Market Cycle, Getting the Odds in Your Favor, he is called the king of distressed debt. He's been doing distressed debt since 1988. And he said in his book, I hope I never live to see another downturn like 2008.
Oh boy.
A lot of distressed debt and some distressed assets in 2008. Well, let me tell you this, he is now gearing up the largest distressed debt fund in history, at least in his history, I should say. And so are a lot of other players who've already collected tens or even hundreds of billions of dollars getting ready for this. So at least Howard Marks and some other very large players believe this is going to be a very, very serious plague on business. And there's going to be a lot of opportunities to acquire distressed debt, distressed assets of all types. We all know that hotels are going to have a terrible amount of time, especially independent hotels, but also chain hotels.
Right.
We know that retail was already teetering on the edge. I mean, listen to this. There were about 12,000 retail closings in 2019 in one of the strongest economies in American history.
Correct.
What's going to happen now? And we've already seen JCPenney follow in the footsteps of Kmart and Sears and declare bankruptcy. We saw Hertz declare bankruptcy in the last 48 hours. So I think we're going to see a massive, massive amount of defaults. And those who are ready, you know, people have been criticizing Warren Buffett for years for having $126 billion in cash on hand. Did you notice he didn't spend it when he could have in March during the downturn? I think he knows that the worst is still coming. And of course, he's all about, you know, pro-America and the wonderful future of America. So he doesn't want to say it. But I believe that he and many others think that this is going to be the worst downturn in recent history, if not all history, and therefore the best opportunity to acquire a whole lot of assets and create a whole lot of wealth.
That is very enlightening. Thank you for those wise words there, Paul. Another thing I will add to all this muddy waters, as I say it, is also the insurance side of these things. You know, a lot of, you know, offices or small businesses have been closed, you know. And what people perhaps don't realize is all these buildings and suites are all living and breathing entity. You cannot just, you know, turn off the lights and air conditioning and things like that. You have to worry about air circulation and mildew, mold issues, you know. So I see this as a mini crisis building as well around the insurance and litigation side of these things, is that when businesses are coming back, or perhaps will come back in next few months, that they're going to start opening the doors, I mean, they're going to find lots of trouble around behind the walls and things like that, you know. Could you maybe have some comment on that, Paul, as to, you know, how that's going to play out as well?
Yeah, well, a friend of mine in your area, actually, I think he rents, at least $3 million in annual lease payments he makes office space around the DC, Maryland area. And I think he said that they have realized they do not need all the office space they have, and they're already starting to negotiate with their landlords to break those leases. Well, he's just one guy, and they're a very wealthy company. If that really does, you know, if that really is the wave of the future for multiple reasons, we can imagine that it could be. I think offices are going to be deeply, deeply hurt. And like you said, there's all the other secondary issues that become primary if you let them. And that is all the problems with the buildings, the litigation. I just can't imagine. This is going to be, I mean, as sad as this is, and I mean, literally, it's tragic. I think this is going to be the best time ever for lawyers. And I hate that, but I think it's true.
No, I know these are very, very, I think, very serious, uncertain times. And I mean, a lot of pain is yet to come. And I do not know if this is going to be as rosy as saying that, hey, we're going to thrive in commercial markets. I just don't know. I somehow, one part of me probably sometimes thinks that, oh, we're still sliding. I just don't know that, oh, the roses are still blooming.
Right.
Would you think, like, I know as we are recording this in late May, incidentally, you have Bigger Pockets show coming on this Saturday here, where you're going to talk about the crisis investing 101 and how different markets and different cities are going to recover. Could you share some lights on that, Paul, as to what is your take on some of this?
Yeah, so Atom Data Solutions, that's ATTOM, did a study that was published a couple, maybe 6 weeks ago, about what they think are the most likely cities to recover most quickly and which ones will be the slowest. 10 of the top, the best cities were, no surprise, in Texas.
Mm-hmm.
They think that they'll bounce back the quickest. Surprisingly, California only had one county. Actually, these were done by county. One county that was on the list of the worst 50, and that was Shasta County, where Redding, California is. In the whole Western U.S., there was only one other county, and it was near Phoenix.
Interesting.
That was really, really in the bottom.
Mm-hmm.
New Jersey, shockingly, had, I think, 13 of the worst counties. They think that will take the longest to bounce back. Florida had about 10 of the worst counties. They think they're going to get hit. Now, they measured this. This was in terms of real estate, by the way.
Mm-hmm.
So they measured this in terms of loans underwater or near underwater, foreclosures in the fourth quarter of 2019, back when things were great. They measure it in terms of job losses, things like that. What they didn't do a good job of, in my opinion, I don't think that they did a great job of measuring how hard COVID hit in these areas and how hard, really how deep the job losses were, because obviously the job losses in, let's say, New Jersey are going to be very different from a place like Idaho.
Sure.
And so, but that's what happened in that group. Now, there's the analysis I'm going to be doing tomorrow. Of course, this will be long, before your podcast is published, is of the ratio between rents and property sales, home ownership sales. And of course, we want to get the highest ratio of rent to property value or property sale price. And so I'm going to be analyzing the top 25 rent to price markets tomorrow on my show. Now, you may be surprised to find out that Detroit, by far, and I mean by a huge margin, almost double the next competitors, wins in the rent to price ratio. And mainly the reason is that the average home price is only $35,500, but the average rent in 2020 was $1,116. And so Detroit was ranked number 1 in 2015, and they still are today. We also have Birmingham, Alabama, Cleveland, Ohio, Baltimore, Maryland.
I can imagine. I was just going to say that, Paul, there is that a lot of these, I think when you said rent to price ratio, I clearly remember all these stats from back in the days from 08, 09, when, I was extremely buying these properties voraciously. That ratio works in a lot of darling cities, like, as you pointed out, the Ohio's, the Indianapolis, the Alabamas, the Tennessee, Memphis is another town, Baltimore, Detroit, of course, so those cash flowing towns where I think the neighborhoods have to be safe, it just works. And these downturns, and I went through the 08 crisis as well, and we found that these, blue collar neighborhoods, safer neighborhoods tend to be very resilient, and that's why we say sometimes that, yes, single family has its own place and in general, So I thank you, Paul. I greatly appreciate it. I know as we are recording this at the, end of May, I think the pandemic is still unfolding. The states are just starting to reopen, perhaps really county by county, city by city for that matter. And we don't know really whether the virus is still going to make its second comeback and what that's going to entail in terms of, for the cities, the health practices and things in general, right?
Right.
So I really feel that the pain is still ahead. The things are still unfolding. And I think it's a wait, watch, and see what that is going to do to our economy and real estate sector in general. So with that, Paul, I thank you for your time today. I would love to have you back again. You bring in a wealth of experience, knowledge, and some practical knowledge that all listeners got to hear. Would you mind sharing, Paul, how listeners can get back in touch with you, and also your podcast, How to Lose Money?
Yeah, so we have a wealth building podcast. It is called How to Lose Money. And we talk about the failures and pain of successful entrepreneurs and investors on their road to the top. So we don't have to repeat those mistakes.
Absolutely.
The best place to get hold of me is at my website, wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com.
Thank you, Paul. It's been a pleasure. I appreciate your time, and I look forward to chatting with you again in future. Thanks. Thanks a lot.
Thanks, Sakar.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.